In this video, I'll be discussing something that's a little bit abstract, and that is fundamentals for currencies. There are a lot of different reasons a currency can move, and quite frankly, it's way beyond the scope of not only this video, but any video, of course, because there's always the outlier. However, in general, there are a handful of major reasons that tend to make up most of the fundamental reasons for a currency movement. The first one's political. So, for example, recently, as I record this video, we had the UK vote to leave the European Union. You can see that the British pound was just absolutely pummeled for this. And that's because there's a lot of uncertainty. We don't know what trade's going to be like for Britain, and traders absolutely hate uncertainty. A political decision like that can really rock the markets. Also, there can be things such as if a particular party wins election in a particular country, maybe they're not as business friendly as the previous one that had been in power. That can be negative, or vice versa if they're actually very pro-business. Those kinds of situations, though, tend to occur in smaller countries, as for example, like the euro covers, well, 27 countries now. It takes a lot more to move the euro based upon just one election. So you do have that possibility. Without a doubt, the de facto reasoning for a currency to move is interest rate expectations. So in this particular scenario, not only did we sell off due to the potential trade problems, but it's very possible the Bank of England will have to cut rates, so that really drives down the value. The higher the interest rate that the central bank pays, the more people want to own bonds and invest in the country, and vice versa. So expectations are for lower interest rates for the British pound, or the British central bank. So with that being the case, it's a little bit less investment in the UK, and you've seen that reaction. Also, you have to keep in mind that some currencies are driven by other markets. So, for example, and this is especially true in commodity currencies, the Australian dollar is highly leveraged to gold. So as demand for gold grows, demand for the Australian dollar grows. We've recently been rallying gold, and here we are rallying in the Aussie. It makes sense because Australia is a major exporter of gold to the rest of the world. And if you chose to buy gold from Australia, you're going to have to pay those miners and those corporations in Australian dollars, and it drives up the demand for that currency. Obviously, if gold sells off, that doesn't help the currency so much. The reality is, though, that there are other currencies that simply move in sympathy. So this is a New Zealand dollar. You can see in general, it's been driving the same way as the Aussie dollar. And that's because the two economies are so intertwined. So the idea is if it's good for the Australian economy, it's good for the New Zealand economy, and vice versa. A lot of times you'll see this between these two particular currencies. If a employment number is bad, an employment number coming out of Australia that's really, really bad, misses horribly, all of a sudden the New Zealand dollar starts falling as well. It's a little bit of a knock-on effect. You see this sometimes with the euro pound, although that's a little different now that we've had the Brexit vote. Other markets, such as Canadian dollar, can do that. It just comes down to their global positioning. Normally they're right next to each other because that's where you get the most trade, typically. Now, having said that, there are a lot of other reasons that can move a currency, but if you understand the answers to those basic questions, in general, you should have an idea as to where a particular currency may be going.